This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Digging into the archives today, two very important trend-following conversations. I consider these conversations timeless. Maybe you heard these conversations a few years ago. Maybe you are hearing these conversations for the first time today in May 2023. It doesn't matter. The wisdom, the lessons, the perspectives, the insights. If you can't learn anything from these two men, something is wrong with you. Go get medication. See a doctor. Maybe go the full distance and get a frontal lobotomy. That's right. If you can't understand what these two guys have to share with you, it's time for a frontal lobotomy. That is my expert, non-medical opinion, but I'm sure that I'm right. Without any further delay from me, without any further sarcasm from me, let's jump right into Martin Luc from the UK and Jean-Philippe Bouchot from France. Again, two very important voices, great trend-following insights, and perfect, if you will, perfect medication for a time like right now. I hope you enjoy. I've had some interesting debates recently. The content of the debate's not so important, but one of the reactions was really interesting. I was ahead on the facts scorecard. The person that was talking with me was not aware of all the facts. And many times when the facts are not on your side, it devolves into an emotional attack. Usually the emotional attack on me. So if I'm just putting the facts out there, it can cause some people to get unnerved. Long story short, this person said to me, well, you know, I don't want to be like you. I don't want to be, you're going to be an angry old man. You're not going to listen to anybody. You're not going to be open to this and open to that. And I thought it was a really interesting comeback. You're going to be an angry old man. You're not going to listen to anyone. You're going to be too set in your ways. This was a person that doesn't listen to my podcast. I am so fortunate to bring on such a diversity of guests. There's almost no way. I mean, yeah, I've got my point of view and all that kind of fun stuff. But in terms of staying young in the mind, I'm so fortunate to bring on this wide swath of people from all around the world with all different expertises and all different types of disciplines. I'm just lucky. It's awesome. Today is another great example of that awesome luckiness that I have. My guest today is Martin Luc. He is the co-founder and director of research at Aspect Capital, a fund based out of London. It's always had a certain understanding, a certain flair for, a certain success in trend-following trading. For those not aware, Martin was an original founder of AHL, trend-following firm that was started in the 1980s, originally purchased by Mann in the 90s. All that work they did at AHL, and one of Martin's original partners at AHL was David Harding, who went on to form Winton Capital. But all that work they did at AHL was taken over by Mann. Mann built it into at one time, which was the largest trend-following fund in the world. Fascinating success story to start with these three guys, these three young guys in the early 1980s, finding their way into trend-following trading, finding their way into systematic trading. And then to see the branch off, as I mentioned, Martin's now the director of research and the co-founder of Aspect Capital, a very successful firm today. One other note from my perspective. I think back to the turtle story. The turtle story was about two guys that had tremendous success already, and they seeded these new traders, these up-and-comers, and showed them how to do it. But those new traders really didn't have anything. In my mind, AHL is almost that in reverse. So AHL were these young guys with barely anything who ultimately seeded what became 3 of the largest funds in the world. That's a pretty cool story. I hope you enjoy this conversation with Martin. I was thinking about our call today. I'm thinking of all the assorted conferences that I've been at, and I was just wondering if we crossed paths that we never met or something. Or I don't know. You've done these events though. You've done these things.
I have. We've the one I remember seeing you at. I think there's a picture of it on your website. You had Larry and Ed. Is it Sakota?
That's often debated. Sakota. I'm not sure. I think it's Sakota.
How does he say it?
I think it's Sakota.
Sakota. You had him on stage with some. It wasn't ukulele. He got out his banjo.
Yeah. The Whipsaw song. So you were the audience for that, huh?
I was the audience for that.
That was probably an interesting audience. I probably would have, because when you're on stage for one of those things, you're in your own little world, and you don't realize that that's probably a pretty interesting audience at that moment in time.
Exactly.
Yeah.
And it's it's voyeuristic because you guys are having so much fun, and just you could be in a bar, the 3 of you, and the rest of us are like voyeurs.
I sometimes wonder, is it something that comes with age where you loosen up, or do you think guys like Larry and Ed were always that way?
A bit of both. I obviously I don't know Ed at all, but Larry's always been. He's always been older than me, and that will never change. Probably he's always been wiser than me. But, and actually I haven't seen him for a while. So whether he still gets wiser or whether he has just sort of plateaued and that wisdom is enough to carry him through, I don't know.
Yeah, I probably have more interviews with just me and Larry in his office on tape that I can't release. They're awesome wisdom, but there's just a lot of color there that I can't put out.
Yeah. I can believe that, Michael. Listen, it's a pleasure finally to get to speak with you. I have your book on my desk and have owned this for many, many years. So thank you for everything you've done for the industry.
Well, thank you. Thanks for the nice words.
I'm surprised we haven't spoken.
Yeah, it's just, it's kind of funny because it took me, and I should share a really quick story with you. The first time that I met one of your old friends, the head of Winton Capital, and I was in his office, and it was in 2005, and we had just met. It was just me and him and his dog. He started pulling up a screen showing me equity curves of assorted, well-known US CTAs, and then superimposing his equity curve. And then just giving me that wry smile of like, did you somehow or another miss me? That was my first kind of inkling of like the London CTA scene, so to speak, was not at the forefront in the US.
Yeah.
And then there's just an exponential explosion of all of you guys that's just out of this world.
It's an interesting story.
I tell you what, why don't you go back in time? I'm curious, the first moment, and I'm really curious your age. And obviously I know some of the backstory for the audience. That people can do some Google searches and stuff, but I'm curious when you first saw in your mind and you said, wow, this quantitative style, this systematic style of trend following trading, coding it and trading over a diversified basket of markets, when you knew in your heart of hearts, this had changed your life, or at least you knew this could make some money.
Wow. Michael, I think the starting place, and I'm also just conscious of the audience. Michael, David, and I never quite had the luxury, if you call it that, of having a role model. It wasn't as though we looked out at the investment universe and said, I want to be that person or I want to do that thing. Certainly for Michael and I, because we go back further than our relation. Michael and I go back further than our relationship with David. We were at boarding school together from age 13, and then we were at Oxford together. After Oxford, Michael went to work for his father, who ran a small physical commodity broking business in London. I went and took my first job at Nomura, trying to sell Japanese equities to European investors. And Michael, I didn't know what an equity was when I started that job, clutching my physics degree. I was just fascinated by the analysis that Michael had started doing, prompted by his father. So Michael's father said, "Here, boy, buy one of those newfangled computers." There was, personal computers were just beginning to reach the shores of the UK in the 1980s. And Michael bought a Hewlett-Packard 9816. His father, handed a book of technical trading methods and said, "See whether there's anything in this." So the point in answering your question, it's really been so gradual, just over time. I left Nomura, joined Mike. This whole time series analysis just lent itself to, the nerdy physicist's approach. We just discovered some things. We tested every model that we could encode from that great book. We distilled them down to some fundamental rule sets. We tried them on a range of markets. And at that time, Michael, the range of markets that we had available to us sitting in the commodity world of London was, what did we have? Cocoa, coffee, sugar, aluminium, copper, silver, something like that. The financial commodities were really in their infancy. So it was only a few years later and largely, once we'd met David, that we started expanding the application of these models to a more diverse set of markets. So sorry, I have a tendency to long-winded answers. But
I'm fine. I think the audience is fine. People love that depth. People want to know what's going on inside the mind.
Well, and that's what I'm conscious of. I can't, there was no one moment where we said, yes, we have created, the great imitator of, who was around in those days, Richard Dennis, John Henry, the Mint gentleman. But Michael, we didn't know that. As we started doing, we just didn't know there was that U.S. industry.
Mid to late 80s, we're talking right now?
Even early 80s. So I started working with Mike in 1984. He was working for his father, I think, from early 1983. So I think the earliest AHL track record stretches from 1983. We met David, I want to say, in 85 or 86. And there was a bit of a tussle. David was working for Sabre Asset Management and was the understudy to a great chartist, a man named Robin Edwards, who ran a fund, very systematic, but no computers involved. And David he was a Cambridge-trained scientist, and he immediately saw the potential for using computers to encode Robin's chart approach. So the Sabre folks tried to hire Mike and me out of Mike's father's business, and that wasn't going to happen. So in the end, we got David to join us in Mike's father's business. And then at the beginning of 1987, there was a little family tiff, which resulted in the three headstrong boys leaving with one client and setting up AHL.
Now, but at the moment you guys set up AHL, had you made enough money at that moment in time? You felt like I've got a little breathing room, or was it still kind of, we're not really sure what's going to happen yet?
We didn't have a bean, not a bean. In fact, blood is thicker than water. Michael's father gave, as we parted company, and just said, because Michael's dad, had built his business over the years, and it had morphed from that commodity broking firm into a small asset management business based on the models that the three of us were developing. He had a very, in those days, a parochial or patrician's approach to managing money and to the clients. And then there was just a difference of opinion. We said, look, you can't behave that way with your client's money. You can't take a paternal view of it. You have to be completely transparent. And we set off on our own. But we didn't have a bean, and Michael's father actually lent Michael £20,000 that we spent on computer gear and rent until we had generated enough fees that we could go and rent our own office and pay his father back. So, but gosh, it was a very long time before we had confidence in what we were doing, actually.
What were you, kind of a two-part question, what were you calling the style of trading amongst yourselves that you were executing? What were you calling the style of trading? And number two, talk about some of the early coding and how you went about the early coding. This was not the age where you could walk out and buy a TradeStation or a Mechanica software or something. This was hard coding in the bowels, so to speak.
Two parts to that. What did we call it? I don't know. Yes, it was trend following, and it wasn't long before we woke up to the fact that there was an industry here, because we had friends in the brokerage community. So again, through Michael's father's connections, there was a firm in London back in the 80s called Rudolph Wolf. They were a metal broker, and they had cottoned on to this idea of raising, I mean, as you know, Michael, the roots of managed futures was a client would open a managed account and give authorization for the manager, in our case, AHL, to manage that money. So it was brokers like Rudolph Wolf and some of the early physical commodity brokers that helped us and educated us in what the rest of the industry was doing. So we knew pretty quickly that this was trend following, and we started to get exposure to a much broader set of markets. In terms of the modeling and the development, you had in Michael and me in particular real techie wonks. Certainly I would not get a job now as a developer, but back in the day, that's what we loved to do. Those Hewlett-Packard 9816s, actually the operating system was written in Pascal, and we learned Pascal and we built our models in Pascal. And very quickly, we built an environment that allowed you to encode trading ideas quite, much more simply. You didn't need to write them all in Pascal and compile the darn thing and blah, blah, blah. It was effectively an inline simulation language, which got developed in the days of AHL. Once we became part of the Man Group, and it was a well-funded exercise, we had, code writers, developers just working on that interpreted language. So it was a precursor to many of those, TradeStation, and for a while in the period between AHL and Aspect, certainly Mike Adam had a version of that. Actually, it wasn't his, but it was a similar product that he was marketing commercially. So the software development was very much intertwined with the model development, Michael.
I was thinking about some of my questions for you tonight, and I was thinking about the notion of achievement. And everybody, I mean, if they're pushing in some way, is achieving, and we're all striving. And so I think it's sometimes hard to reflect, because here I am, I'm really curious about all these little things. And I think from your perspective, you're just kind of saying, hey, we just started doing this, and it starts working, and we just keep at it. We keep our nose to the grindstone, and there's some ups, there's some downs, and next thing you know, 30, 40 years later, boom, boom, boom. We something interesting there. And then for a lot of outsiders, they look back now and they see the very successful firm Aspect today, but they don't really think about the progression, the evolution.
That's so true of so much in life, is that it's very hard to join dots when the dots don't exist.
Yeah.
You can join the dots with hindsight. So, if I was being really glib, there was a while where the three of us, none of us got those fancy jobs in investment banking that all of our slick friends at university got. So there was the period where, as three scientists, just nerding around with the models and the simulations and the back data and some of Michael's father's money. And heavens, this stuff works. The more we got into it, the more animated and the more excited we got. So we'd have various, there were little sound bites for a while. So it was Revenge of the Nerds for a little while. And then it was, Investment Bank in a Box. Because in the early days of AHL, again, this speaks to just not having the sort of confidence in the models that we've built up, all three of us, over 30 years since then. In the early days of AHL, we did a number of different things, not only model development and asset management. I've spoken about the software development. Michael was already keen on commercializing that piece of software. I, meanwhile, spent a fair bit of time using the software to provide consultancy services for financial businesses. What came to light out of that, Michael, was that you could fairly easily model the behavior and the profitability of investment banks. We did a piece of work for a London gilt trading house. We modeled, how many people, what are their risk limits, what kind of investment horizon they had the front book traders that were making a market, and they had the back book traders that were holding the house book, if you will. And we modeled the behavior of those things. And said, well, roughly, this looks like the profitability of your business. And the folks, the executives, that their jaws dropped. They went wide-eyed because we basically modeled their business. So, that there was we went around telling everyone, you can sack all of your, Goldman, Salomons, just get rid of all of the traders. They're very expensive and they have hangovers. You could build it all on computers. We didn't believe, we believed ourselves, of course, but everyone thought we were completely nuts. By and large, that's what's happened.
I want to jump up to the mid to late 90s in a second, but I have one kind of early type question left. The notion of systematic. So today, an aspect is 100% systematic, right? Strategies are systematized. When did you... I'm guessing that there was probably a moment where, okay, you're doing all this homework, you're in the early stages of this industry, you're seeing the results, but when did you have that aha moment that, like, wow, we should really take the human discretion of the execution of this out, and we should automate this? When was that moment?
I draw attention to two things. The first was just an awareness that your ability to rationalize the available information, if you could do that pretty quickly and get rid of the noise, we'd all be much better traders. So I tell the story of in those early AHL days, Mike and I came up with a game, and it was just a piece of code that would randomly sample one of the markets in our database, and it might invert it and it might multiply it by a random factor. So you couldn't tell what the market was, but it would obviously keep the integrity of the price series, and it would present a chunk of a time series to you and then ask you to buy or sell, and you'd buy or sell, and then it would move forward a day, and then you'd buy or sell and move forward a day, and so on and so forth. And with that kind of rapid fire decision making, actually, we were pretty good discretionary traders. If you blow each of those ticks up into a 24-hour period with news coming at you and fear and greed and, the chaos of normal life, you become a lousy trader. So that was the first inkling that taking the emotion out of it, just reducing it to the raw information has to be a good thing. The second thing, which I think is a theme we might return to, it turns out to be the importance of risk management, because what a lot of people focus on in any model development is the models. Are you going long? Are you going short? How do you feel about this market or that? And that's all well and good. And you obviously need to develop those models and be able to articulate what the underlying drivers are. But I think what many people miss is the risk management component. Where I'm going with this is that what a lot of people do is focus on systematizing the models, and then the portfolio construction and the risk management piece they leave to discretion. Somewhere in the genesis of Aspect, we realized that that's absolutely, that's a crucial thing to get right. You need to be able to systematize not only your models that interpret the price data and determine the confidence you have in that particular trend, but also you need to be able to systematize your portfolio construction process and your risk management process. So the manager that says, I am 95% systematic and 5% discretionary, Michael, is 100% discretionary. That's not necessarily a bad thing. I'm not saying that there aren't many geniuses out there who are discretionary, but it means you can't rely on the scientific process. You can't rely on the quality and the integrity of the simulation and research process if you're always resting on if there's the hint that you're just going to step in and down gear the portfolio when the going gets tough, or you're going to knock out a few markets when they, seem to be a little off the charts, because you can't build that into your simulations and you can't know what you're going to do in the future. So, over the years, although we knew at the outset that it was a good thing to systematize, over the years, I've become more resolute in how important it is across the entire investment process.
It's really interesting. You talk about that notion of 95% systematic and some portion of discretion. That was a very common marketing line in the disclosure documents of trend following CTAs for a long, long time. And it was almost like this mysterious thing, like we're 95% systematic, but there's this magical 5% discretion, which is the reason you're giving us money. And I always used to think about, this doesn't make any sense. Now I think probably because you and other peers, associates, et cetera, have gone the opposite direction and said, hey, hold on. I don't think you could probably get away today saying in the quote trend following space, we're 95% systematic. I think people that want to invest would probably say, explain that.
Yeah. Well, it really depended who you were talking to, and we all lived in fear in the early days of the black box label. So I think there was also an element of, I think two things. I think that 5% discretionary was also to give some investors a sense that there was a thought process, and it wasn't just this, ignorant machine clunking away. But also, I come back to the point that people built the models, and then, for example, the overall risk target of the portfolio was something they would set discretionarily on how it felt that week, day, month, or epoch.
I just think it was a weird point in time where we had not yet got to the point where there was an acceptance of the 100% systematic. So there was this gray area in the marketing, and for good and bad reasons, perhaps, as you're saying.
That's exactly right. And now it needs to be used judiciously. So the idea of being systematic, the idea of being research driven, as an investor, as a consultant doing your due diligence, you've got to scratch at that, because as I give a bright young graduate an infinite amount of data and an infinite amount of processing power, and they're going to come up with the works of Shakespeare, or they're going to come up with models that just look staggering. And you and I know, Michael, that you wouldn't put your money in them. So the difference between 100% systematic models that are based on curve fitting, back fitting, cloud patterns, data mining, versus 100% systematic models that are based on, rigorous hypothesis extraction, testing, and a whole barrage of statistical tests to make sure that you aren't fooling yourself. Big difference.
I have to give a presentation shortly in a country in Asia, a pretty successful capital. And I assumed they knew what I was going to talk about. And they wrote me and they said, hey, can you bring these particular charts for your presentation and tell us whether or not these charts are in a trend or not in a trend? I guess where I'm going with that with you is the diversification direction, because it's amazing that people still, I mean, those people that ask me that, they want to fixate on their markets. They're excited about their markets, and they're not even thinking about diversification. That's not even on their horizon. They've just got their markets they're happy about, and they want me to tell them something exciting about their markets. They're going to be disappointed, but talk about the idea where that's not how you look at it. You are saying, what are the targets of opportunity? When that opportunity arrives, we're gonna do something with it when it arrives, but we can't force it. And I still think today, even in 2015, it's still not a widely understood concept.
I think that's right, and I've been in exactly those situations where, you know, whether it's the local conference organizer who's asking you to tell them how great their local market is, or it's the drinks party where somebody's saying, "What do you think about gold?" I have no opinion. I don't even know what country I'm in, Michael, and which way up your stock index is. But I know it's in my portfolio, and I know it's one of the 150 plus assets that we monitor 24 hours a day, and that we always have a position in. And depending on how those trends have unfolded, we'll have a larger position, and depending on how those trends have unfolded, we'll have a long position or a short position, and that's the beauty of it. So over time, our style, the way Aspect has developed, and I'm hesitating just because I acknowledge that it's idiosyncratic. Many managers will have a different approach from ours, but I start from the very high level premise that all assets have an equal opportunity to manifest trends. So the whole model building process is an attempt to preserve that opportunity and make it as broad and robust as possible. What do I mean by that? What I mean is that if you build your model such that it captures some of the characteristics of different markets. So you trade hogs subtly differently from how you trade treasury bonds, for example. You know, you can think, you know, you can squint and persuade yourself that you're building in some features of those markets, because clearly the world of hog traders is different than the world of bond traders. But I put it to you, Michael, the dynamics of those markets are, you know, that at that level of resolution, there is, in our opinion, no persistency. All you can say about hogs and bonds is that they have the potential to demonstrate trends. If I had looked at, say, equity markets if my data set was, this is somewhat spurious, but say 2000 and U.S. equities, 2002 to 2007, I could conclude that equities don't go down, or not for long. Or if I look at bonds over the last 10 years, bonds don't go down, do they, Michael? Never. So you could build into your model certain biases or certain scenario expectations, and that's what we try and eschew. You know, we try and avoid those built-in biases. I am indifferent as to whether your regional equity market is in a roaring bull trend, which I know is what you want, conference organizers, or whether it's in a terrible, terrible bear trend. I'm agnostic as to whether it's going up or it's down. And I don't look at how different markets have performed historically and say my models are better at trading commodities than they are at trading financials, and therefore I overweight the financials. I try and keep it as completely agnostic directionally and asset allocation wise, so that it can grab hold of any opportunity that presents itself.
Let me see how I can ask this. So you've traveled a lot. You've talked to a lot of different people. You've had a long career on so-called, quote, Wall Street. What percentage, and this is clearly you can't give me an exact percentage, but I'm curious, when you're talking to people and you're meeting people after all these decades of going down this path, what percentage of the educated financial audience do you think really grasps what you do at Aspect?
Fortunately, Michael, many more now.
I think, is this a hedge?
than did for most of my career. I mean, the irony is that 2008 was largely for, I think for the majority of the finance. I mean, this is terrible generalizations and therefore probably not true. But from my small vantage point, 2008 was the aha moment. And before that, marketing what we did could sometimes be a struggle. And you know that. And the whole, the secular growth of our industry from being backwood, real cognoscenti, esoteric stuff. And we have to say we didn't help ourselves, Michael, with the absurd fees that we used to charge back in the 80s. The evolution of that to, making ourselves look respectable and I want to be a hedge fund too, all the way through to, I think 2008 was where, as a result of that period of performance, 2009, the phone started ringing and the pension funds and the pension fund consultants that wouldn't take our calls up until that point said, explain again how this stuff works. And then they were really receptive. And of course you can't make it up, because then ironically, of course, in the aftermath of the global financial crisis, you get a period where this stuff isn't as, didn't perform as well as it had done historically, and as well as our expectations would lead us to believe it does and it can and it will. So, to answer your question, I think that the vast majority of people now get what we do, but it wasn't until relatively recently that's been the state. That's been the state of the world.
Yeah, because you bring up an interesting point that 2008 was this watershed where people said, "Okay, wow." I put this in one of my books. I don't know, the analyst. I don't think he's an analyst, but author. This kind of guy that talks on the shows on TV, Ben Stein, and he said, if you made money in October of 2008, you were doing something wrong.
Really?
and it strikes you funny because it's like, but I know where he's coming from. I mean, I know from the vantage and his understanding of sort of trading strategies or investment strategies, where he's coming from. And I guess if you only believe that, then I guess that's a fair thing to say, but it's an amazingly, you're really leaving some things out to say that. But I just love that line though. That's great, right? If you made money in October of 2008, you were doing something wrong.
I love that line. That is a great one, Michael. And I think that, none of us in our industry should think, and I think the respectable ones of us don't think that we've ever finished. It's not like you've ever, I've unlocked the secrets of the markets and my model is my model and now I'm off to the beach, because the markets never leave you alone, and B, there's always some new thing that you hadn't thought about. So yeah, in 2008, I think very topical at the moment is the evolution of portfolio construction, the theory and the practice of portfolio construction. You'd gone at the time, a very learned gentleman, Swenson, the Swenson model of diversification was don't just have US equities, have global equities. There you go. Now you're diversified. I'm oversimplifying it, but certainly he has had, and as far as I know, has no interest in quant strategies. And at the time that was perceived to be a very valid and very useful form of diversification. And in 2008, that's why you get lines like, if you lost money or if you made money in October 2008, you were doing something wrong, because the worldview was so so rigid. So I think it's exciting, and it keeps me young, and it keeps my research team young and energized, because there's always some new worldview that you should explore.
One of the things that I think is really interesting, I've had some of the brightest and most accomplished behavioral economists on my podcast. And what I really find amazing in talking to them is that their work seems to be the embodiment of the traders like yourself, your peers, the other associates in the industry, these going down this systematic quant trend strategy path was really, in many ways, capturing what a Daniel Kahneman was winning the Nobel Prize for, what a Vernon Smith was winning the Nobel Prize for. So I find it really interesting. But when I talk to them, it's amazing that there seems to be this disconnect where all these behavioral economists should be waking up to these quant trend strategies and saying, wow, what a wealth of interesting data and evidence for us to sink our teeth into. But there still seems to be a wall where they've not yet kind of like pulled the hood of the car up and looked under there and said, interesting.
I agree, Michael, and vive la différence. I'm very happy that those folks and the folks at Google have not have not woken up to what it's do. But you talk about behavioral economists. One area that has sort of fascinated me and is the building of agent models. So if you can define players in your complex system, who are the hedgers, who are the speculators, who are the counter trend traders, all of that, you'd think you could come up with a bottom up model for the markets, which perhaps, I don't know, is that what behavioral economists are trying to do? In my limited experience, candidly, don't bother. It's a very elegant mathematical model, but it's very unlikely to be able to make you any money. I think the thing about what we do, Michael, is that it's a bit rough and ready. The models are very sophisticated, of course, and the mathematics is complicated, but it's you almost start from the premise that all markets will at some point display trends, and it's our job in these models to be able to capture those trends efficiently and not lose money in the periods where we're participating in those markets and they are not trending. There you go. I've just defined what it is we do, but you'll notice that I haven't dwelt on, and it's my job to tell you why those trends exist, where they come from and where they're going. And so I think if you fixate too much on that, which is the role of the behavioral economist, you very fascinating field, but it's not what we do.
Yeah, when I look at what they do, I just see, okay, they seem to do a great job of really putting aside the efficient market hypothesis and offering that, hey, human beings are not always so rational, and bubbles exist. And so if I just look at that very basic premise, their work gets more complicated than that, but that very basic premise, it kind of dovetails right into your world in the sense that it's kind of a foundational explanation for why you might be successful.
Yes. Yeah, and I think it is, and it makes for great reading, and often there are aha moments as you say, yeah, well that's why we sophisticated monkeys behave the way we do, and long may it continue, Michael.
Let me ask you kind of, as we kind of wind down, let me ask one kind of a current big picture issue for aspects. So I'm calling you from Southeast Asia today. The world is a very interconnected place. Everybody's coming online. If a country doesn't have a liquid futures market yet, they're surely thinking about it. They would surely like one. So we can all. How do you go about this process of bringing new potential opportunities, new potential trading opportunities into Aspect? Talk about I imagine you always stay excited because you're like, hey, we don't even know the next grouping of markets from the next country that's going to come online that can possibly offer us opportunity. I think what's so great about trend following, and in many ways, it is the Indiana Jones of trading in the sense that once you have your models and your systems and stuff, and that these markets in these countries are liquid and viable, you can go in.
Yeah. It's an ongoing process, and it's something we devote a fair bit of time and a fair bit of money to, because you've got to keep your heads up. As you know, Michael, it's relatively easy to get started with the 50 most liquid markets out there in the world. And if you just ignore all of the new stuff that you're referring to, you miss a huge opportunity set. As a business, we have a regular cycle of reviewing, news alerts, and our brokers keep us prompted of what's new, what's coming. We like to have some back data, so we're not going to be market participants on day one of an exchange opening, because we've got to get the sort of characteristic heartbeat of liquidity patterns within that market before we can parameterize our execution algorithms. So we've got to establish a little bit of history, and then we've got to establish a threshold of viability, a threshold of liquidity, because it's got to be worthwhile. At a certain point, having a 1 basis point allocation to a market where it isn't viable in the program. So there's a liquidity threshold. I think there's something like 6,000. Is that right? 6,000 futures markets. Globally, you can very quickly cut off 80% of those on liquidity basis as being viable for what we do. And then it's an evolving cycle. As liquidity picks up, we will adapt our allocation in the portfolio. So, and the other feature, of course, Michael, is that there may be constraints. So, for example, we can't currently trade the Chinese futures markets for our investors, because external investors are not allowed to participate in those markets. Similarly, access to Brazilian futures markets, which are vastly liquid. There's a taxation situation that makes them extremely difficult and expensive to trade. So all of those markets we're tracking, we're collecting data, we are simulating the models on them, and we're ready to go at the drop of a hat should the legislation change. And we welcome that. We love the additional diversification that it affords the portfolio, because back to the starting point, if you just traded the same liquid 50 markets that maybe we started with in the 1980s, if that was your portfolio now and all other things were equal, you'd have less diversification in the portfolio, because there's a long-term, a secular trend towards markets becoming more homogeneous over time, I believe. So we are hungry for new axes and new opportunities of diversification.
Why do you think you're so passionate?
I'm a one-trick pony. This is what I've done my career, Michael. I am, by nature, I can't claim to be a scientist or a physicist, but that's what I studied. And I think I got into that because I'm inquisitive, and I like precision, and I like answers, and I like engineering solutions to things. So I know myself that I would be that I am a lousy discretionary trader. I like the application of sophisticated mathematical techniques and theories to extract signal from noise. And I love working with a bunch of really, really smart, talented people. All of that keeps you passionate to keep learning and to keep competitive and to keep doing what we're doing better and better.
I mean, even if the economics of this was much less, let's say it was good enough to earn a living, I get the feeling talking to you that this still would have been your passion and your path.
Absolutely. This is just great fun. I didn't set out on day one to be a great trader at all. As I said, I got into this working for Michael's father because I was fascinated by the application of computers to time series data. That's what I've done my whole career. It doesn't really matter that the rewards have been very good. That's a nice feedback loop, actually. Markets are a very, swift judge of how precise and how honest you have been. So
it's how to keep score.
It's how to keep score, exactly,
Yeah.
and that means that I'm not in an amorphous world of where people could say, "Wow, what a great article you've written." There's a scorekeeper.
Yeah. Martin, listen, it was fun chatting. Hopefully we can talk again in the future. Everybody can go to Aspect Capital and easily find more information on your firm. Appreciate it. Great stuff. Where are you today? You're in America today.
Yes, I am just outside of Boston. I'll be in London tomorrow and in Southeast Asia next week. I'm sure I will be hot on your heels and, in the aura of Michael.
Oh, you're too kind. Hey, Martin, listen, I appreciate it. Thank you very much.
Nice talking to you. We'll do it again soon.
Today on the show, I have Dr. Jean-Philippe Bouchot. He is chairman of a multi-strategy quantitative hedge fund called Capital Fund Management. He's co-supervisor of the research team. He is a well-known authority in the field of econ physics and a co-author of Theory of Financial Risks and Derivative Pricing. He's a professor of École Polytechnique, where he teaches complex systems. He is a member of the European initiative called CRISIS, standing for the Complexity Research Initiative for Systemic Instabilities. And he holds a PhD in theoretical physics from École Normale Supérieure. I hope you enjoy this conversation. So I want you to elaborate on your physics background, but bring that into this framework of classical economics. Classical economics, the rationality of economic agents, the supposed rationality, the invisible hand, market efficiency. But for some reason, the idea of empirical data often gets left out of the equation. And I think, and I've seen this with some other traders that have had success, a physics background is different. It allows you to maybe look at the world through a wider lens.
Yeah, exactly. I mean, I'm surprised that you say all of this, because that's more or less what my usual message is, and you've captured it all in a few words. Yeah, it is true that I'm a physicist by training, and physics is of course learning through doing experiments, and you learn that theories are no good if they're not able to reproduce observations. And even if your theory is beautiful, if it doesn't fit, it doesn't fit, and too bad, and you just have to throw it in the dustbin and start again. So, as a physicist approaching economics and finance back in the early 90s, that's what struck me most, is that there's a philosophical aspect to the way economics and finance theories are built, very much axiomatic and imagining how the world could be or should be, and then developing the theories without much care about what's going on out there. So I guess that for a while it was justified to do that because data was not so easy to access. So the whole academic world has developed without data in a sense, and so people had to maybe supplement the lack of data by axioms and by ways of thinking that can happen too in physics, actually. But so perhaps I was fortunate enough to enter the field when data became very easy to access, and when looking at data and trying to make sense of data through a kind of vivid light on the failures and drawbacks of efficient market theory and Gaussian statistics, Black-Scholes, all this to me was quite apparent that it was not enough to understand the world.
But you mentioned Black-Scholes model. It's still in use. So even though that systematic underestimation of risk is well known by people like yourself, it's still in use.
Yeah, I know. I've been ranting about that for ages, and one problem is students. You have to teach students something, and Black-Scholes is so easy to teach, and it's so beautiful mathematically that a lot of people just resent the idea of having to put it all down and start again with something more messy. Of course, the world is messy, and being messy, it's much harder to teach, to focus on the right things. And by definition, you have to form your intuition on something else than mathematics. And I think that's why physics is good at that, because it gives you a lot of examples where you can put your hand in the dirt and try to push on some button and see what happens. But I think the same should be more and more true with economics and finance now through two channels. One is the availability of data and the possibility to make experiments on data, simulations, that is, and even without data, you can do simulations. You can invent worlds of people trading according to certain rules, or firms producing according to certain rules, and implement whatever rule of thumb or feature of the world that you think should be there, and then just run the simulation and see what happens. And then what's very striking when you do that, first, it's fun because you kind of play God, and second, very quickly you realize that some of the rules just don't work. They don't represent at all what is seen out there, and others seem to capture something that's very close to reality. And so my impression is that by training people more and more with this type of background, this type of experimental background, in a strange sense, because experimenting with simulation is a strange notion, which actually, even in physics, it took a little time for people to accept that simulation was a legitimate way to do science. I don't know if you know Mark Buchanan. He's a science writer, and he wrote a few years back something on numerical simulation, which I like a lot. So if you give me 1 minute, I'll find the exact quotation, because as I said, I think he's spotted it right with his own well. Okay, so I have it. So Mark Buchanan, in an article, op-ed, I think it was, in the New York Times, just after the crisis in October 2008, said the following: done properly, computer simulation represents a kind of telescope for the mind, multiplying human powers of analysis and insight, just as a telescope does our powers of vision. With simulations, we can discover relationships that the unaided human mind, even with the human mind aided with the best mathematical analysis, would never grasp. And for me, this is the essence of what the physics way of doing things has brought to the game.
Just so people don't think that perhaps you're giving an interesting marketing story about a physics background for your trading firm, your firm does not hire traders. Am I correct?
Yeah, it only hires physicists. And okay, people can think that, but we've been saying the exact same thing since the mid-90s when we started. And I know for a fact, for two reasons. Well, first of all, because the everyday life of CFM is driven by data, is banging our heads against data and trying to make sense of what we see and make models inspired by what we see. And the second thing, which shows that it's not pure marketing, is that I think we're very strange as a trading firm to have published something like 100 scientific papers in the last 20 years. All published in academic journals, which shows that it's really in our DNA to consider science as the right way to do things, if you want.
Well, let's jump right into my primary reason for reaching out to you today, which was seeing your paper, which really didn't have any big fanfare, just kind of all of a sudden appeared in the internet ether, and 2 centuries of trend following. And I wonder if you might lay out a scenario for how that paper came to be, and then we can discuss some of the specifics inside it.
Okay, so as I said, we've been publishing papers for 20 years now, and this particular paper was on the back of our mind for a long time. There are 2 reasons for it to appear right now. One may fall in what you call marketing, which is that we've been launching in January this year a fund called Institutional Systematic Diversified, and a part of that fund is based on long-term trend following. So it is true that we needed to give some support to why we're doing that. And the second thing is that we recently, in the course of the very last few years, have had access to much longer time series than we had in the past. And in particular, we've been able to go back to beginning of the 19th century on commodities and indices in terms of data. And so this allowed us to backtest quite a number of ideas, and in particular trend following. And in a sense, to our surprise, we realized that the strategy has been extremely consistent since, well, as long as we could go back in the past. And this seemed to us to be a very interesting finding on the year where the Nobel Prize is given to Fama and Schiller and Hansen as well. But this debate on the efficient market hypothesis, on which I've been pretty vocal myself in the last 10 years, I think it is ironic that it's given to Fama, who's still arguing that there's no bubble, there's no crashes, that the market went down in 2008 in anticipation of the crisis and not the other way around, and that everything is perfect. And trend following momentum in general is something that efficient market theorists have a real difficulty to explain, because that's completely out of the framework. I mean, it's very hard to evoke some kind of risk premium that would be associated with trend following. So it has to mean that markets are not that efficient. There's a lot of other clear discrepancies between theories and reality, but I think this one is a very genuine and clear one, which talks to everybody. I mean, just looking at the trend on the long time scale is giving information on the future motion of the market, then it really means that all the public information is not included in the price right now. So for me, it's both from an intellectual and commercial point of view a very interesting finding.
I thought the statement that jumped out at me was, and this is from your paper, quote, "The existence of trends is one of the most statistically significant anomalies in financial markets," end quote. And that's a powerful statement.
Well, we've been looking at financial markets in the last 20 years, and it's very hard to find extremely significant statistical effects. You can find them on the high frequency side, but then there's a lot of murky things around high frequency. First of all, costs are tremendous if you want to trade at high frequency. So it's not clear that all the high frequency anomalies that have a strong statistical signature are, as economists would say, very relevant from an economics point of view. On the other hand, these very slow trends, where a lot of money can pile in and has piled in, is of course much more mind-boggling in a way, and also has to be taken into account both for academics, but also from the point of view of professionals.
A couple of the other interesting facts that I thought in the paper, perhaps this is obvious if data is going back to the early 1800s, but trend predates trend following, which I thought was interesting. I think also too, and I'll let you expand on that and expand on this, is the idea that it's actually a very small percentage of traders employing trend following models that make up the volume. So the idea of trend predating trend following, and that actually the traders using these models today make up a very small percentage of the volume.
Yeah, I agree. Well, you can see it both ways. I would rather say that actors systematically implementing trend clearly is posterior to the existence of trends. But I would say that traders on aggregate using trends is probably the reason why trends are there in the first place. And people using trends have been around for for 200 years. And that's my interpretation of what we see, is that there's a lot of people, of even small people, who on aggregate play the role of trend followers and therefore create these trends.
You know, it's interesting also, you mentioned FOMO and the split Nobel Prize. I had a chance to speak with Harry Markowitz recently, who's very lucid. And the point that I made with Harry was, you know, Harry, did you find it interesting that when you wrote back in the 1950s, this is what we should be doing, that within a few decades, other academics had taken what you said we should be doing and had said, this is what we are doing? And his response was, well, I think you're going to have to talk to the behavioral economist about that. He didn't want to touch it. But his point being is that, you know, I never said this is what it is. This is what we should be doing. And other people interpreted it to come up with these, as you might say, these hard axioms that became rules, the foundation of the efficient market hypothesis.
Yeah, it is a strange field in the sense that there's clearly interaction between what people do and what people observe, and the use of Black-Scholes in 1987 is another vivid example of how things can go wrong when wrong models are used. That's what makes the subject fascinating also for a physicist, because you have to go kind of one step further and try to understand how the models themselves might change the game. So actually, we came up with a simple model on how, you know, trend could lead to trend, or mean reversion could lead to mean reversion, and a priori both are equally possible. I mean, you know, that it's not clear that we could imagine a world where people would follow mean reversion rather than trends, but it seems that humans have such a propensity to follow trends. There's a lot of very interesting psychological experiments where you can show that you know, when a small child sees 3 points aligning on a line, it gives him pleasure. So there's clearly, we're wired in to extrapolate past trends, and that's probably a way to, you know, extrapolate the motion of a tiger jumping on us or something that makes us alive today. So my intuition is that it's much harder to go against the trend than it is to follow the trend. And again, there's a lot of very interesting psychological or even biological experiments showing that there's a lot of things, hormones going in and out our body in the two situations. One when we're conforming to the crowd, and the other when we're not conforming to the crowd. There's a pain associated not conforming to what's going on.
Classical economics has no framework through which to understand wild markets. And wild is your phrasing. And I wonder if you could talk to the idea of classical economics not having the ability to have a framework to see those wild markets, to see through them. But how do you, when you use the word wild, what does that mean to you?
Yeah, okay. So you're referring to a paper that I wrote in 2008 in Nature, which was just after the unraveling of the crisis, and this made me react very strongly because I felt that this was, you know, in the cards, and of course other people had seen it coming, but I was not too happy with the way economists had been kind of dismissing all the attempts to introduce a little more wildness in the description of economic systems and financial markets. So actually, wild is a reference to Mandelbrot. Mandelbrot has introduced fractals. Of course, he's introduced also the idea of distributions without second moment, without variance, or infinite variance, and distribution with infinite means, and that's his classification of randomness, if you want. So he would call benign randomness the one that economists love, Gaussians and things where the average, where you can replace a heterogeneous system with its average. And we know, for example, this relates to the book of Piketty as well, that the distribution of anything in economics is so broadly distributed that very often it just doesn't make sense at all to replace a collection of people by an average people, by a representative agent would be the the classical word. But coming back to Mandelbrot, benign randomness is the one that I just described, whereas wild randomness is the one that is difficult to tame. And it's difficult to tame because it's hard to speak about averages and variances. And so that's really what I was referring to when using the word wild. Now, why is economics in general not able to capture these big swings? It's very strange. It's because the models are constructed to be intrinsically stable. It's like, people insist on the fact that a rational world is a stable world. And so your model should be stable. And so economics model come up with equilibrium points which are intrinsically stable. That is, if you perturb them by a small amount, they're going to naturally go back to equilibrium. And this is so much ingrained in the model that it's by definition impossible to have a crisis. And what's interesting is that when you remove a few of these rational assumptions and introduce market imperfections, then it's very easy to find situations where the rational equilibrium of economists, even if it still exists, is actually unstable. It's perturbed by small external shocks in such a way that the system goes out of whack for a while, and this is what we would call a crisis. So I think that the mathematical apparatus is there to allow us to not only describe, but anticipate to some extent, or at least make space for crisis in the economic world. And for me, this is a fascinating topic of research on which we've been focusing in the last few years.
I'll leave you with this, but I think the fun thing talking to you is you sound like you're having fun with this subject. You have fun with what you do. You get to wake up every day and have fun. Yeah,
exactly. That's totally true, and I'm happy you say that.
There's not much more to say, but you can just I could feel it because it's an experiment to try and find empirical data, to try and solve the puzzle to the best that you can, given that there's always going to be uncertainty. And I think what I have loved over the years talking to you today, many of your peers, is just that when one accepts uncertainty, there's a certain honesty to it. And I think it's a lot of discomfort for me when people are so certain about what's going to happen. And so I personally enjoy.
But I think that's a big difference between physicists and economists. And I think there's a lot to be written about this. And in a sense, I would say that we're privileged as physicists because we don't have to talk to politicians and we don't have to make statements about how the world is supposed to work, in the sense that, nobody's relying on us to make political decisions. And I think there's a huge amount of pressure on economists because they're under the spotlight. They have to come up with stories and decisions. And this means that it's very hard for them to take a step back and say, okay, I'm really going to try to understand what's going on here. And maybe it's going to take me 10 years or 20 years, but at the end of the day, we'll have a better theory for the world. And I've been said that by many people who said, okay, well, all this is great, but what am I going to say to my Ministry of Finance when he asks me about should I raise tax or should I do this or that? And it's true that it puts people in a bad situation because they can't think long term. And as you just said, as physicists by training, I think what we love is to be able to think that we understand something. And if we fail, well, it's okay. There's nothing wrong in failing. We know that the physics has had so many revolutions and so many things that people were actually convinced were true turned out to be wrong in the end. So it's an incredibly good vaccine against what you said earlier against certainty and a certain form of arrogance as well.
I guess to some degree you're expecting failure, and maybe some of the economists don't want to. They can't acknowledge that there might be failure.
Yeah, Yeah, because the field is constructed completely differently for sociological reasons as well.
Yeah. Hey, Jean, I appreciate you taking the time today. This was great, and I hope you enjoyed it. And I think the audience will enjoy listening to your insights, and hopefully we can chat again in the future as the wild.
Very happy to meet you someday. Of course, we've liked your book, as you saw. It's actually referenced in our paper, and I'm very happy to have been able to talk to you today.
Yeah, it was fun. It was fun. I appreciate it. It was good chatting. To find out more information, you can check out the Capital Fund Management website. Also, to see the trend following white paper we discussed, 2 Centuries of Trend Following. Google will bring it right up. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.